The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. Now, the world watched as $1 trillion was wiped off the stock market in a single day. A huge bonfire kindled by the little-known Chinese artificial intelligence startup DeepSeek. Now, its release of a new AI model known as R1 upended assumptions about U.S. supremacy in AI and raised the prospect that some in China are learning how to beat Silicon Valley at its own game. So is this the end of the AI race? Should investors still stay invested in the AI world? Well, to find out more, joining me now is Desmond Chua, who is investment counselor of Citigold Private Client at Citibank Singapore. Desmond, welcome to the show.
Thanks for having me.
Thank you so much for joining us. Desmond, news that a Chinese AI innovator was able to rival the capabilities of leading U.S. providers with a fraction of the costly chips sent Nvidia's market cap down by $600 billion in a single day. Now, this news sent shares of not just Nvidia, but AI-related stocks plummeting. Shares subsequently rebounded, though. But Desmond, does this ring alarm bells on being invested in shares of AI-related stocks?
Yeah, I think rather than alarm bells, we can interpret this event as a gentle reminder. Essentially, the innovation in AI can be highly disruptive, so even to the leaders in the field. So we really should be cognizant that idiosyncratic risk or company-specific risk, especially in the mega tech AI stocks, is actually higher than many people realize. So this is really because the valuation of these few firms do actually dominate global indices.
Right.
Yet on the flip side, the recent rebounds does actually highlight the resilience of the AI trade. So I think the overall takeaway here is that we need to have an appreciation of the landscape which is dynamic and always evolving. And thus, I think for our portfolios, we need to be adaptable. This is the key to mitigating risk while hunting for the opportunities out there.
I see. Well, Desmond, then should investors still be invested in Nvidia and other major tech companies at this point?
I think the bottom line is this: AI adoption remains a long-term trend. So this event is really not the end of the so-called AI boom. In fact, I think it's just the beginning. So think about it this way. With this whole event, right, we know that capital intensity for AI development might actually be reduced. And so this is actually a potential catalyst for software AI adoption. In one sense, you could say that AI is ready for democratization. So as a result, I think AI software developers may actually emerge as the next big winners. So I think, ironically, it's important to note that portfolio concentration to just a few well-known names in AI should be considered very thoughtfully. Like I mentioned earlier on, the three largest U.S. tech firms actually make up 20% of the entire market. So you think about it, that's actually huge. So from a portfolio construction perspective, investors should really diversify across AI themes like software and not only just hardware. So also, investors should consider diversifying to other sectors, like utilities, energy, or even digital infrastructure.
I see. Well, the news that AI may be less microprocessor intensive also hit utility and energy infrastructure shares. How have utility and energy infrastructure shares reacted specifically, and why have they been impacted in this AI chaos?
Yeah, so similarly, utility and energy stocks actually declined. This is really because investors had to reassess the long-term power demand from AI data centers, which by very nature are very energy intensive. So essentially the fear is that if AI does not use so much energy, right, this essentially you have to reduce the projected energy demand boom that had driven utility and energy infrastructure stocks higher in the first place. But on the contrary, we actually see AI and digital assets, together will actually continue to drive long-term power consumption. So we actually think the sector's growth story remains very intact.
I see. Well, what does this recent event then say about experimental technology? What should investors understand about innovations in experimental technology? And is there more, an idiosyncratic risk in U.S. mega caps than some investors seem to understand?
Yeah, so experimental technology like generative AI, which people know as ChatGPT and DeepSeek. So these sort of technologies are highly unpredictable. I mean, just think about it. 2 years ago, no one has heard of these companies, and yet everyone talking about them right now. So the risk is that, when disruptive technology like that comes out or experimental technology gets proven, it actually can lead to massive valuation swings in stock. So the biggest industry leaders can be disrupted, and then essentially competitive advantages or the moats in these companies should no longer be perceived as a given. So I think the upshot is that we need to understand that innovation can create both risks and opportunities. So we need to be diversified. Now, on to the idiosyncratic risk, like I mentioned earlier on, the top 3 tech firms actually represent nearly 20% of the U.S. equity market. So this is, that concentration will make, anyone's portfolio very susceptible to single event risk. So yes, market concentration risk is increasing, especially in these kind of names. So, we have to be very cognizant of this particular concentration.
I see. So will the latest breakthrough end the AI arms race, or are there still opportunities with these, U.S. mega tech giants?
Yeah, definitely not the end of the race. Like I mentioned, the barriers to entry is actually lower right now, so more players can actually participate. So in other words, the way to think about it is the race, you have a strategy in a race. The strategy is actually shifting now. So, it's actually shifting towards efficiency and software rather than just pure hardware power. So as a whole, I think AI remains a very high growth sector, and that firms that can adapt essentially by using cheaper AI methods or innovating in software will continue to drive. In short, this event is a shift and not a stop in the AI evolution.
I see. Well, speaking of opportunities then, why might software designers for the AI industry be clear winners for this year?
Yeah, I think the challenge has always been for software developers is really the cost of, compute power. So if now AI models can be trained with fewer chips, the bottleneck essentially will ease. So this put developers in a very strong position, and many companies now will be able to participate in AI model training, automation and deployment. And this will also see more investment inflows, right? Because there's more potential for usages across the different sectors of the economy.
I see. Then which sectors in the AI industry may remain to be the biggest losers?
Yeah, so I think offhand, the market's reacted the way it has. So semiconductors, particularly high-end GPU providers, may actually face challenges, right? But I think this is not necessarily the base case. Now, besides this, utilities, energy infrastructure stocks may actually also experience short-term pressure if AI demand forecasts are revised downwards. However, like I mentioned earlier on, the long-term demand for AI compute power and data centers actually is a structural growth trend.
I see. Well, given this outlook, Desmond, how should investors then allocate their portfolios to hedge against any risks that come with the AI game?
Once again, diversification is the only free lunch, so we should not over-rely on just a few mega-cap tech names. So consider, exposure to the rest of the AI trade, like in software and other downstream or rather other areas that are benefiting, like midstream energy sector or nuclear power, even digital assets infrastructure. These can be beneficiaries of, the new administration deregulation agenda, as well as AI expansion. Importantly, I think if one finds, this environment really very hard to navigate, just look to actively manage investments where professional managers are able to identify, the risks as well as manage volatility.
I see. Well, then for those investors who may have a lower risk tolerance and want to stay away from these disruptions, what other assets can investors consider? Where are the opportunities?
Yeah, it's important to diversify a portfolio, in general, looking at equities and bonds as well as, alternative assets. But that being said, I think we still have a preference or overweight in equities. So I think the way we look at it is to essentially reduce the concentration away from AI risks and look for opportunities in other sectors. We do like the banks, the financial sector, that's going to benefit from deregulation. Like I mentioned earlier on, we like midstream energy companies. So these actually have fee-based models which will be driven by, energy consumption by AI data centers. We like nuclear power that's turning out to be gaining traction as a reliable source of low carbon energy source. And of course, when you look at equities, look at dividend-focused equities, right? They tend to be more stable and at the same time having that income visibility.
I see. Well, is there anything else you'll be looking forward to in the next couple of weeks within the AI space before we let you go?
Definitely exciting. We have to definitely look at how U.S. firms are adopting to Chinese AI efficiency breakthroughs, right? So are we going to see more companies adopt these models? And it's also earnings season, so I think CEO and CFO conference calls are important. We look to them for insights as to how companies are capitalizing on these changes. And I think from a policy front, to see if we might see country administrations think in terms of how they want to implement AI or energy or digital assets, as part of their overall national strategy.
I see. Amazing. Well, thank you so much, Desmond, for your time and your insights today.
Great. Thanks for having me.
Thank you. That was Desmond Chua, who is the investment counselor of Citigold Private Client at Citibank Singapore. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.